Welcome back to our channel. Today, we're going to discuss a recent survey that has shed light on a concerning reality faced by borrowers. It's a topic that deserves attention, as it affects many individuals and families. So, let's dive right in. The survey, conducted by the Reserve Bank of Australia's Financial Stability Review, revealed some alarming findings. Following multiple interest rate hikes, many bank borrowers are facing challenging circumstances. In fact, nearly half of them may be at risk of defaulting on their debts within just 3 months if they experience unexpected changes to their income or expenses. It's important to understand the reasons behind these interest rate hikes. The central bank has been taking these measures in an effort to curb persistently rising inflation, a concern that impacts us all. Surprisingly, the bank decided to raise interest rates once again earlier this month, catching both the market and economists off guard. This marked the 12th increase in the past year, defying expectations of a pause in June. While the majority of borrowers are managing to meet their monthly payment obligations, there is cause for concern. The survey revealed that borrowers lacking sufficient funds to cover their monthly loan payments for at least 3 months, known as a prepayment buffer, are more vulnerable to defaulting. Let's take a moment to understand what we mean by prepayment and buffer. A prepayment refers to making a loan payment before its due date, while a buffer represents funds set aside to assist with payments in case of a temporary reduction in income. The Reserve Bank's analysis also included future forecasts based on certain assumptions. If borrowers don't take measures to reduce their spending, the projections indicate that up to 14% of debtors may run out of money by mid-2024. Even if extreme cuts to discretionary expenses are made, an additional 9% of borrowers would still face the risk of depleting their funds within the same timeframe. These projections become even more concerning in scenarios where unemployment rates rise. If households were to reduce their spending by up to 80%, approximately 10% of them would exhaust their emergency funds within 6 months. Furthermore, the research discovered that 16% of borrowers with low buffers are currently on very low variable rates, making them particularly vulnerable to default if interest rates were to rise further. It's worth noting that borrowers with low buffers are also less likely to have savings outside of their home loans when compared to those with fixed-rate mortgages. While this includes some first-time purchasers, they do not represent a disproportionately large portion. However, it's the low-income and high-debt households that are anticipated to face greater challenges in the months ahead and beyond 2024, even with reduced monthly mortgage payments. The survey reveals that low-income households typically have limited resources to draw upon or the ability to cut back on discretionary spending in order to allocate more funds towards debt servicing. In January 2023, over a third of low-income borrowers' income was allocated to mortgage repayments, a significant increase since the first interest rate hike in May 2022. On the other hand, 5% of borrowers in the top income quartile spend more than a third of their income on home loan payments. However, due to their overall higher salaries, they are better positioned to manage the increased debt service expenses. The Reserve Bank's analysis further indicated that household spending was relatively restrained in the first quarter of 2023 due to the impact of rising interest rates. However, the bank predicts that most households will still be able to continue building their savings buffers, albeit at a slower pace compared to the previous 2 years. It's important for us to be aware of these findings and take steps to secure our financial well-being. Understanding our prepayment buffers, maintaining a careful balance in our budget, and exploring ways to manage our debt can go a long way in navigating these challenging times. Thank you for watching today's video. Remember to subscribe to our channel for more insightful content. Stay informed, stay proactive, and together, we can overcome these financial challenges. See you in the next video.